Today's webinar is entitled The U.S. Wayfair Decision, Untangling the Web of Sales Tax and What European Businesses Need to Know, and is brought to you by the European American Chamber of Commerce, where Europeans and Americans connect to do business. I'm Todd Schwartz, Executive Director of the Cincinnati chapter of the EACC, and I'll be your host today. And I'd like to turn for just a moment to my colleague Yvonne Bendinger-Rothschild, who is the Executive Director of the EACC chapter in New York, for her to offer brief welcoming comments.
Good morning, everyone, and welcome to our program today. The seminar today is a little bit of a niche topic, but we felt it's important to host this discussion due to the current situation and the pandemic's effect on online commerce. We get a lot of inquiries from European companies who want to sell into the United States, and for the time being, they're taking the route of doing that online, and which is why we decided to do the program. It was actually suggested by Betsy to host this event, and we pulled it forward in the calendar for that reason. I also would like to invite you to watch your email. We have a lot of other seminars in the pipeline, among them one with the European Trade Commissioner, Phil Hogan, and we can hope you can join us for that. Thank you. And with that, over to Jared, who is going to run the conversation today.
Actually, I've just got a couple finishing remarks. Thank you, Yvonne, for your welcome. So we have over 70 registrants for today's event from the Netherlands, from France, from the United States, and I'm sure we're going to have a very vibrant transatlantic and international discussion. One quick disclaimer. Please note that all comments and opinions presented by our speakers today are their own and do not necessarily represent the views of the European American Chamber of Commerce or its members. So back in 2018, the U.S. Supreme Court handed down a decision in a case brought by the state of South Dakota against the online retailer Wayfair, which fundamentally changed taxation policy in the United States. This decision allowed U.S. states to require businesses to collect sales taxes for any sales in that state, regardless of whether the business had a physical presence in that state. Since that time, many U.S. states revamped their rules in a bid to generate revenue, and now many businesses feel that doing business in the United States is like doing business in 50 different countries. Here to help us make sense of all this is Betsy Gillen, Managing Director of Gillen Tax, joining us from her home in New Jersey, and Jared Johnson is a principal at Offutt Kerman. Jared is connecting from Philadelphia, where it is always sunny. So Jared, let me start with you. This seems to be primarily a domestic U.S. tax issue. So why is the European American Chamber of Commerce organizing an event like this, particularly for European countries?
That's a great question. Right now, we are about 2 years in after the Wayfair decision, and we've been able to let the dust settle a little bit and see how states are responding and implementing that new tax policy. Particularly for European companies, however, this is a shift from what they're accustomed to working within, moving from a federal system to a more decentralized system, as you mentioned, where sales and use tax is a little bit of an adjustment from the traditional VAT that European companies are accustomed to operating within the European Union. What we've seen over the last 2 years are we've allowed the issues that those companies or that those countries are specifically dealing with in transatlantic trade, we've allowed those issues to bubble to the surface. And now we're seeing what those issues are, and we can address them a little bit more specifically. Now, granted, there are issues that overlap a great deal with other non-US companies coming in, and we'll discuss a lot of that overlap as we go along. In fact, it's the general idea and concept of Wayfair and individual state taxation is universally applicable, and we'll certainly touch on that, and there will be those concepts, but we will address specific European issues also further down as we go. so that we can hopefully facilitate a lot of this, a lot of the business as it goes back and forth. As we begin, I'd like to see, by a show of hands, what your from the participants, what your experience level is with U.S. sales and use tax, whether that is the frequency of interaction with sales and use tax or the complexity of the issues that you wrestle with. If you could take a moment and just indicate the level of your experience, I'd appreciate that. That will allow us to gear our comments towards some of the different levels that we have attending here. And as Todd mentioned, there is the Q&A function. Please feel free to answer those questions as we go, or to ask questions, and we will attempt to answer them as we go. We don't want to move off of a topic. If you have a question on it, we certainly want to address as much as we can and answer as much as we can. Todd, do we have those results in?
So, yep, let me share these results. As you see, about of the people who responded, about a little under 60% have said identified themselves as beginners. About a third is intermediate, and a little over 10% believe themselves to be experienced in this topic. So, there you go.
Okay. Well, excellent. That helps a lot. One thing that I will admit is that after today, you may be very grateful for VAT, but we will do our best to simplify the U.S. sales and use tax as much as possible. And please do not hesitate to reach out for help or assistance as you work through your issues. Betsy, do you want to go through our discussion topics for today?
Sure. Thank you, Jared, and thank you, Todd, for the introduction. And thank you to the EACC for allowing us to present today to you. You know, it's interesting because a lot of the companies that we work with, so Jared and his firm are on the legal side and deal with a lot of planning issues and a lot of, you know, transactional issues. And my firm being more of an accounting firm, we sort of deal with a lot of the numbers and compliance and how do you determine whether you have a sales tax filing requirement and what do you do once you figure out that you have one. And so we receive a lot of questions from European companies that are coming into the US or considering having operations in the US. And so like you, they're wondering sort of the basics. What are the sales tax rules? There's something called Nexus in the United States, and we'll help you understand what that is. And that basically means who is subject to tax in the U.S., what types of transactions are subject to tax, and at what level do you need to report and remit taxes in the U.S. There are issues that are specific to European companies, and not necessarily European companies, but even companies within the U.S. or even in different jurisdictions that may not have a normal relationship with a particular state, but now because they're selling into a state because of Wayfair, they may have a connection that they didn't realize that they had, or perhaps they're receiving a notice in their mailbox saying, you know, do you have any relationship with our state? So there are a lot of questions that come into play with, you know, whether or not you have you know, how to answer those questions, how to answer the notices, things like that. And then we'll discuss some of the basics about sales tax compliance and filing requirements. What happens if you are audited? What happens if you receive a notice? And planning. Where do you go from here? So you've digested some of the information that we've given to you today, and how do you think about that in terms of your business, and what does it mean to you? So that's our agenda for today. And I'll pass it back to you, Jared.
All right. Thank you, Betsy. It's been fantastic working with Betsy, and I do appreciate her depth of knowledge with the sales tax issues, and working with her on preparation for the returns. Now, going back to understanding, first off, the imposition of tax in general, and where states derive the authority to just impose a tax. The federal Constitution requires that that there be some kind of connection, some kind of jurisdiction before a state can even purport to collect some kind of tax from a company. Now, where does that come from? How do states get it? They get that through the 14th Amendment of the Constitution. Now, from that, the Supreme Court first established that, all right, in order to assert jurisdiction over a company, there's got to be some kind of connection. And that's what that minimal connection is. Now, what is the level of that minimal connection? And that is the nexus, that word nexus that Betsy mentioned. That's that line. That's what gives the state the authority. Now, within nexus, there are 100 different shades of gray, and there are possibly thousands of different jurisdictions that have defined nexus differently, whether that's by the intensity of the transaction, the volume, and we'll get into all that. But that is the level of connection that we're looking at. Now, Wayfair, what that did was it modified the that baseline for nexus. Betsy, do you want to talk about that?
Thank you. So do you mind? Yeah, sorry. Right, so general sales tax rules, and like Jared mentioned, this is driven around the concept of nexus, which existed before Wayfair. It's actually been a long-running sort of concept within sales tax. So in the US, just to kind of step back a little bit, you have the United States government and the federal tax obligations that you have. Unlike in the EU, there is no sales tax at the sort of country level. Everything is passed down to the states. So in the US, if you have operations in the US, you may be subject to income tax and you may be subject to sales tax on your transactions. So let's say you have an office in New York. You have nexus based on a couple of things: whether you have property in a state, whether you have payroll in a state, and whether you have sales in a state. And for income tax purposes in the US, if you're in a state, you may be subject to tax for income tax purposes, but not for sales tax. And sometimes, and more often, you're subject to tax for sales tax, but not income tax. So sales tax is a transactional tax similar to that, but leveraged at the state level, and each state has its own separate rules on whether you qualify, whether you rise to the level of nexus. So just a typical example pre-Wayfair is if you are a European company and you have a headquarters in the US. If you have taxable sales in that state, let's say you're a wholesaler, you may have a taxable sale, but it may be subject to an exemption. But let's say you're a retailer in New York, you wouldn't have an exemption. So that it's very complicated. I know I'm making it sound complicated because unfortunately it is. But at the basic level, if you have sales in a state, if you have employees in a state, or if you have property in a state, then you may have nexus for sales tax purposes, and you likely will. So like I said a minute ago, before Wayfair, if you did not have a physical presence in a state, you didn't necessarily have to charge sales tax in those states. So in my example a minute ago, let's say you're a retailer in New York State, and you sell to New Jersey, the neighboring state. If you don't have quote unquote nexus with New Jersey, if you have no other contact with New Jersey other than making that sale, then you wouldn't have had nexus in that state. So let's say it used to be a good example was a company called LL Bean, which is a mail order type company. and they had only an office in Maine through much of their history. And people loved to buy from LL Bean because they didn't have to pay sales tax, because LL Bean was only in Maine. Most likely they didn't live in Maine, so the goods were shipped to them without sales tax. So essentially they got a 5 to 7% discount on that purchase. The way sales tax works is somewhat similar to VAT, in that the sales tax is charged to the purchaser and remitted on behalf of the purchaser by the company. So, in the olden days, it was a great benefit because you could ship goods to a different state and not have to charge sales tax. And then after Wayfair, in 2018, obviously now we've become a much more digital economy, and each state was saying, hey, we're not getting our fair share of this. This purchaser, this Elizabeth Gillen, lives in New Jersey and she just bought something from LL Bean. She should have paid tax to New Jersey. She technically should have self-assessed. So what happens is, if you are a company that sells to me, if you're LL Bean and you sell to me, I didn't pay tax in New Jersey, but I should have self-assessed. I should have paid a use tax on that purchase, on the, let's say, 5% that I would have been charged if LL Bean had Nexus with New Jersey. But most of the time, people didn't self-assess, so the state would be missing out on a lot of revenue. So in this new digital world, Wayfair is a company that sells furniture online. And let's say they only have a distribution center in South Dakota, which they may have distribution centers in a couple of different states, but a lot of states are missing. So they make sales into New Jersey, and before Wayfair, they wouldn't have had to charge tax on that New Jersey purchase. But that really didn't represent what was happening from an economic standpoint. So the Supreme Court in 2018 ruled that Wayfair, an online retailer, was required to charge sales tax on sales in the state of South Dakota, which normally they wouldn't have had to charge sales tax in. So the term of nexus was modified to include economic nexus. It used to be that we talked about substantial nexus or the three earlier mentions. So it changed, it created a very big change in the way that we look at nexus from a sales tax perspective. And Jared, I'll pass it back over to you for types of nexus that we now have as a result of Wayfair.
Sure. Now, as Betsy mentioned, there are a lot of different interpretations of what constitutes nexus. Each state has come up with its own, and in some cases, more than just the state. So the different kinds of nexus legislation that have been derived in order to impose that sales tax and establish the sufficient nexus, we have click-through nexus, affiliate nexus, economic nexus, and marketplace. Now, economic, as Betsy mentioned, is the baseline. That allows for the least amount of contacts with the state, of course, with individual thresholds for the states that have adopted economic nexus. Now, for click-through, going back to the top there, that usually requires that a remote seller not only reach the minimum sales threshold, but also from using, they meet that threshold using an in-state referral agent. And that is usually where the in-state entity places one of the company's links on their website. And through using that in-state entity, it then takes them to your remote seller or company in order to derive business from within that state. So that's click-through nexus. For affiliate nexus, it requires a little bit more of a physical presence. That requires that the remote seller or the company meet the state threshold through using a physical in-state affiliated entity. That could be a retailer. It could be someone who uses an in-state employee or an in-state contractor to promote the company's sales or facilitate their sales. Now, that affiliate legislation does not require that the affiliated entity have common ownership with the selling entity, but just that there be some kind of relationship there. At the same time, it may not refer to delivery or service, depending on the extent of the connection with the affiliated entity. Again, that is state by state, and there we get into examining the specific relationship. Finally, marketplace nexus legislation is perhaps the least onerous to remote sellers and to other companies. That legislation imposes the obligation for imposition and collection of sales tax on the marketplace facilitator. That could be Wayfair, as we've discussed. That could be Amazon, eBay, and each state, again, has a different definition for what qualifies as a marketplace facilitator. Now, in addition to all those various types of legislation, there are many different activities that could impose, that could result in perhaps unintended nexus with a given state. So that could be participating in a trade show, providing a seminar, using an answering service, even registration with the Secretary of State, or something as remote as storing data within that state. And there are different jurisdictions that have styled themselves to target the business of different companies for different purposes. There are storage favorable jurisdictions, there are data favorable jurisdictions. They provide better tax structures for depending on the kind of your company, the kind of business that your company is in. Any of these actions can pull you into a state. It just depends on the level, and again, you'd have to look at the specific situation in the specific jurisdiction.
Thanks, Jared.
Betsy, do you want to talk about specific states?
Yep. So, like we talked about a few minutes ago, every state is different. So, unlike that, where you have a generally consistent framework throughout the EU, every state is different. Each of the 50 states has a different rate. They range from nothing. There are a few states that have no sales tax. And there are states that charge about 8.5%, 9.5% sales tax. And there are many situations where there are rules in the state about that create sort of a floor for you. So let's say you sell one, I'll switch it to a software company in a minute, but let's just stick with something more simple, which is, selling a fixed good. We can stick with Wayfair. They're selling a piece of furniture to you in a particular state. So if Wayfair is located in, let's say their distribution center is located in Tennessee, so they have Nexus in Tennessee. So if they sell, even pre-Wayfair, if they sold into Tennessee, they would be subject to sales tax, and they would charge that tax and add it to the bill that is sent to the customer. Now post Wayfair, no matter where you are, basically, you'll be charged sales tax at the rate where you receive the good. And that's a pretty simple example for something that you receive that's a physical good. It gets to be much more confusing and complicated when you get to digital goods, because let's say you're a SaaS retailer. There are specific rules for software as a service, and if you need to charge sales tax for your SaaS service. So some states have a floor based on the number of transactions. Some states have a floor based on the level of sales. Like for instance, New York, they have a level of sales. If you sell less than $250,000 into New York and a specific number of transactions, then you're not subject to sales tax for those. You're exempt. So every state has a different set of rules. There's a pretty good, and it's not affiliated with me, so I'm not plugging anything of my own, but there's a pretty good blog called TaxJar in the US. And you mentioned this too, Jared, yesterday. And I think it's actually a software as a service. So you pay a monthly fee, and they provide you some of the details for what the minimums are. And that's a pretty handy, if you're just trying to get a general idea of what types of transactions are subject to tax in different states. That's a pretty good way of getting a handle on it. If you're dealing with complicated, structuring and where you want to do business, where you should locate particular pieces of your business, and what happens, with compliance, that gets into a different level where you really need an advisor, someone like Jared or like myself. But if you want to get a general idea of some of the parameters, you can look at a blog like TaxJar. I'll pass it back to you, Jared.
Now, as Betsy mentioned, with the number of different jurisdictions that we have to wrestle with, just a couple of examples to provide you with the variety that we have across this new decentralized system. Just a couple. Alaska has one uniform set of legislation, but they've left it up to the local units to determine whether to implement that legislation. Alaska has well over 100 different jurisdictions just within that one state. Colorado has deferred to local enforcement. Louisiana is highly decentralized, at least until July, and that's still on track, where they will have a state level legislation for that collection. Right now, Kansas does not have state level legislation per se. It's only a rule. See, shortly after Wayfair, states rushed to implement their own sales tax rules because it became a gold rush of sorts. That was free money for the states, and they decided we want that. So they turned to using rules, and a lot of the legislation, the law itself, in most states it's been passed. Kansas has not passed it yet. They were going to be in session to pass it this summer, but that's been stalled because of the pandemic. Florida also has been suspended, and Missouri. Right now, that implementation date is January 1. Sorry, that's 2021 or 2022. They haven't decided, but again, their state legislative entity, their state Congress, has not been able to convene. I mentioned earlier that there are different marketplace facilitator rules. Now, with 50 different states and an even greater number of localities, some states defer to the cities. New York, for example, they allow New York City to set their own local sales tax requirements. Philadelphia is another one. California alone, you deal with 3 different tax collecting bodies. The Board of Equalization handles the collection of sales tax. The Franchise Tax Board is another one. It just depends on which state you're in and whether you're dealing with a state level Department of Revenue or a local level.
So the question is, the big question that you probably all would like to know is, because I'm a European company and I'm selling into the US, am I still subject to sales tax? And the answer is a definite yes. And before we go on a little bit further, we did have a couple of questions that we can try to address now. The first is, do you see any parallels between the Wayfair decision and the OECD's proposals around digital taxation, or do you think it'll be a contentious issue between the US and EU going forward? Jared, you may have more thoughts on this than I do, but my opinion is that it's very difficult when you're dealing with the US. The OECD and the federal government are often in negotiations, but when it gets to the state level, they kind of are running their own. It's like a pack of dogs that it's hard to sort of corral them. And so I think there will definitely be a contentious issue. I think it will probably be dealt with at the federal level. And then the federal government will, try to negotiate with the states. But as Jared mentioned in the beginning, in the US, we have something called the States' Rights Doctrine, which basically says that the states have the ability to control their own matters with regard to taxation and other things. But I think it'll definitely be a contentious issue. Digital taxation in general for sales tax purposes is difficult. And so there will be definitely discussions, I would think, but I don't know that there would be much resolution. And Jared will also address this in just a minute. And then the other one is, how do you determine where your customer is located, especially for digital services? I think you'll cover that in just a minute too, Jared. And it does differ by state. And we do have one other one. At the beginning of the year, a company does not know if and when it will reach the threshold to pay sales tax in a certain state. Does it only have to start charging sales tax as soon as it reaches the threshold in any given year? And does that need to be reviewed again every year? Yes, it needs to. You start charging once you've reached the threshold, and we advise reviewing this quarterly. I'll pass it back to you, Jared.
Excellent. Thank you, Betsy. Yes, with the between the OECD and the digital tax proposals, that actually surrounds this specific issue here with the non-US companies. See, generally the tax treaties have applied between the federal government and whatever foreign country that tax treaty is for, and that's only applied to largely for income tax purposes, just to ensure that the taxpayer wasn't double taxed. Now, with state sales and use, you have this transaction, and a state, a specific, whether it's Montana or North Carolina, they have not turned over sovereignty for the imposition and collection of tax to the federal government. For that reason, states aren't parties to, they aren't necessarily parties to a federal tax treaty, and for that reason, that makes it difficult to negotiate with 50 different states and even more localities with the OECD, and more importantly, to reconcile what the OECD's proposals are. I wouldn't categorize the relationship as contentious. I wouldn't see it going in that direction. The word that I would use more is cumbersome. And I really like Betsy's imagery. It's a pack of wild dogs. It's trying to get all 50 states to agree on something is like herding cats. That's why we have U.S. Congress. With one more peculiarity, unique characteristic of the U.S. tax system is this availability of Qui Tam enforcement. Now, that is, in the context of state sales tax, that's a little relatively new. Within the last 5 or 7 years, it's been made available to private entities. And I'll talk about that a little bit further down. Todd, if we could look at the next slide. Okay, so getting a little more specific into European companies, sales and use tax is similar to VAT. There are some similarities and quite a few differences. So it's a type of consumption tax. It's imposed upon the transfer of a good or service to from one entity to another. Now, whether that's, and this is where there's a bit of a distinction, that could be business to consumer, which is generally what where VAT comes in. I know there are allowances for business to business. Now, sales and use applies across the board, business to business. Now, there are some exemptions. There are some ways to get out of the application of sales and use from business to business, but those are specifics, and we'll talk about that in a bit. For sales and use, the collection of it is similar to VAT. The company collects it, they remit it to the taxing authority. So enforcement is similar. The taxing authority can go to the company and require the payment. Now, a little bit of a distinction with VAT, the categories of what the goods or services are, those can be defined by local government. And again, not only do we have 50 different states and even more localities, they can set different thresholds. They can also define products differently. So whether a product is classified as a candy can have one definition in one state and a different definition in another state. What qualifies as manufacturing, what percentage of improvement on a product qualifies as a new product, the creation of a new product versus simply an improvement on an existing product and therefore retail. Again, those are distinctions, and it does cause you to react like the little guy on the slide. You start holding your head in your hands, wondering how far that goes. So also, as Betsy mentioned, the calculation that's set by local government, and she did mention the tax software. I know Betsy also has more professional grade software that she runs in preparation of her tax returns, and I love to rely on those more complex levels of software than just what's out of the box for the consumer. Let's go to the next slide. Okay.
Thanks, Jared. And then I'll just go back to Dasha's question before I go to this slide, which is how do you determine where your customer is located, especially for digital services, and does that differ per state too? For digital services, there are very specific rules. So whether you have a SaaS application, whether you have a software that is delivered through different means, whether it's through a hard copy or through the cloud, every state has different rules. That tax jar software that I mentioned, they do actually have information about digital services just to get an idea of, so you can think about your type of company, but I'm happy to, either Jared or I are happy to talk with you offline about what your specific situation is, and we can kind of guide you in the right way. So now tax compliance and filing. So the questions that we often get are, okay, so now we're starting to operate in the US. What does that mean to us? Do we need to set up a sales headquarters in the US? Can we operate directly from the European country, one thing that we would recommend is that if you're going to be doing consistent business in the US, you most likely want to set up a US entity. Because there's something that is unrelated to sales tax, but just a general piece of advice, which is there's a concept in international tax in the US called permanent establishment. And if you have a permanent establishment in the United States, then you are subject to tax. And in the US, we have a system that is based on an entity structure, so that if you create a corporation in the US, you can essentially shield your liabilities in the United States and also shield the tax that you would be liable for to that individual entity. If you don't have an individual entity in the US, then you may be subjecting your entire group or whoever the seller is in your European country to tax within the US, which is something that, one, from a dollars perspective, and two, from just an administrative difficulty perspective, you don't want to do. So one thing that is not necessarily on the slides, but we would recommend if you have consistent sales in the US, to create a US entity. Once you have that entity, then you register to do business in a particular state. So in our example, we're LLB and we operate in Maine. We create an entity in Maine, and then we register to do business in Maine. Post Wayfair, now we sell to Betsy in New Jersey. We now have to register in New Jersey. So we register to do business in New Jersey with that same entity. And this is a simple example because it's much more complicated in terms of planning. Then we reach our threshold in New Jersey of sales, and we now have to remit sales tax. And depending on the tax and the state, you may be required to remit sales tax, collect and remit. So you collect the tax as of the sale date, and you remit it either on a monthly, quarterly, or annual basis. And those requirements are changed based on the state that you're in and the level of sales that you have in that state. And then Jared will talk a little bit later about, some of the planning ideas. But really, as you become more complex, one, it's really important to get your sort of ducks in a row early on so that you're not dealing with these issues like 3 years later. You want to make sure that you've set it up properly from the beginning. And as your operations grow in the United States, you may actually consider having more than one entity, because you don't want to, similar to the concept of operating in Europe and then creating a business in the US, you don't want to subject your one business to sales tax where you could plan your way out of it so that you don't have to hit those thresholds. We can flip the slide. And I'll just, I'll pick up where Todd left off, which is to say that this is your opportunity to ask questions. If you'd like to choose the Q&A button if you have questions. So now you have either set up your business in the US or you haven't, and you now receive a letter in the mail from the state, and it's a state that you've never heard of. You didn't even know that you made sales into that state, and you may be getting something called a Nexus questionnaire, which is essentially a digging opportunity for the state. They will ask you a lot of questions about the operations that you have in their state, and you want to answer these questions very carefully. And Jared will be talking about this a little bit more in a minute too, but when you receive a Nexus questionnaire like that, I would recommend that you have somebody take a look at it too, because you don't want to, let's say New Jersey is a good example. Like Jared mentioned, some things are subject to tax. I have a Japanese-owned specialty chemicals company that operates in a number of different states. And if they were to say that they treated their good as candy, it would be taxed one way. And if they treated it as a component of candy or a flavor, it would be treated in another way. So just by the way that you answer these questionnaires will lead you to a lot of pain or nothing from a state. So it's really important to get those right. Particular areas of state focus, digital is very big. Trying to understand whether you have made sales into a particular state. kind of going back to one of the questions that we received earlier, on a digital basis, let's say you have a cloud-based software, if there are no particular rules in a state, let's say, so I have a tax financial software, and I sell to accounting firms. Those accounting firms are in 50 different states, but maybe my billing address is in New York. Just because it's in New York doesn't mean that that represents where the economics are happening of that sale. So you have to be really careful about, where you're going to be charging sales tax for, especially like cloud-based software. Those are big hot issues right now. Risks and costs of non-compliance. The risk is that you will receive either notices from the state or notices with penalties and tax assessed. And then once the tax is assessed, it's being based on a number that the state is estimating. And then you have to fight your way out of that number. So it's really, again, very important to be proactive and making sure that you're compliant early on. One thing that we don't have in the slides also is that this is a very big issue for due diligence. So if you have an exit strategy and you plan to be, either purchased by another company or have some sort of other transaction, it's a very big issue that the buyer will look very closely at sales tax, where you've paid tax in the past. And from a state perspective, if you don't report your sales and file your tax returns in a particular state, that opens up your entire history for that state. So it's a really big due diligence issue. So make sure that you file early and often. And then just to answer one question too. So Claudia says, so from a customer's perspective, is it possible that they don't have to pay sales tax earlier in the calendar year, but would have to pay taxes later in the year? Is the period always a calendar year? It depends on the state. Some states actually are not on a calendar year basis. They have like a June or a July year end. So every quarter would be 1 month off of the year end. It depends on the state. Do you want to go to the next question, Jared?
Sure. Yeah, I was going to take the next question and move through these a little bit with a little bit of time that we have left here. Ted asks whether the move to the nexus basis for sales tax relates to the move toward destination sourcing for state and local income tax. I'm an attorney. The answer is yes and no. The move to nexus basis is not the result of a move towards destination sourcing, but I'd say that's flipped around. The transition towards destination sourcing for state and local is more of a result of moving towards a nexus basis standard. So, or an expanded, it's always been nexus based, but it's more of an expanded nexus at this point. But what that has resulted in is, among international cross-border transactions, you have comparative law analysis, right? And what that's resulted in here is more of a domestic comparative law analysis for tax regimes. So that's what's happened, and in determining where to grow your company, which destinations are more ideal in order to minimize tax liabilities, and everything that we've been talking about, where to establish your nexus, that is all the result of this expanded nexus policy that we now have. As far as your individual rights among, when you receive an audit notice or someone from the State Department of Revenue reaches out to you, your first thing to do is look at what your rights are. Every state has a Taxpayer Bill of Rights, and you have a list of what the general rights are Some of them expound on greater contact or understanding or opportunity. There is always a bottom line decider, and that is the state court. But you've got to go through all of your steps within the Department of Revenue first before you even reach there. 9 times out of 10, the matter gets settled. So make sure that you know what your rights are in that specific state. You can generally understand that it's going to have to do with notice, your opportunity to talk with the Department of Revenue. But this is important to remember. You always have a right to be represented by someone in working with the Department of Revenue, whether it's your CPA, your accountant, your attorney, whoever it is. So when you receive contact from the Department of Revenue, your first thing to do is to make sure that you're polite, make sure that you're courteous, and then make sure that you reach out to whoever prepares your tax returns, make sure that they're involved, and involve your tax professional, whoever that is. Then as you work your way through the audit, there are a number of issues that they address. You have an unqualified right to privacy, and you can always present evidence. The important things to remember: don't miss a deadline, especially if you are appealing. If you did not agree with the state decision, make sure that you appeal, but don't miss a deadline. I wanted to go back to one of the things that European companies struggle with, especially during, and this results in a sales tax audit, and you struggle with it during the audit itself, is a language barrier. There are not a lot of written materials to understand the imposition of sales tax, and in the various European languages. Another issue is in understanding use tax. So it's not just sales tax, but we have to remember that we're also addressing use tax and what that is. Use tax applies where you purchase the product in another state for use in a different state. So there are specifics. Everything that we've said that applies to sales tax, yes, it applies to use tax as well. So we've just expanded the universe of potential taxes there. So make sure that you keep that in mind. Todd, we're going to go down to the Qui Tam litigation, and then we'll jump into planning a little bit. One thing that it's loosely affiliated with audits, but isn't quite familiar with other businesses, is the opportunity for, and this is private tax enforcement. Generally, business will say, okay, well, what if I don't register with the Secretary of State, I don't register with the Department of Revenue, and I don't collect sales tax? How are they going to find me? They're not going to get me. Generally, that you see Qui Tam litigation come up where a third party gets audited and records for your company come up where that third party has taken deductions for amounts paid to your business that hasn't registered, and that third party can then sue in civil court your business for indemnification for the amounts that became due. That is, and you see it here, that's Qui Tam is short for that long Latin phrase. But generally, you can run into it with vendors, subcontractors, employees. The business is considered to hold the sales taxes in trust for what should have been collected, and that can be a private action against the business, and that's especially something that we don't want to run into. Okay, so for our next steps, we want to look at planning. We want to go through and make sure that you don't run into these issues. Betsy, do you want to take that for our last couple minutes?
You know, I think we've gone through a lot of these, and really depending on the type of activity that you have, there are different favorable jurisdictions. It really depends on what industry you're in. For manufacturing, there are certain states that are good for manufacturing. There is a particular exemption that allows for if you are make a component of a certain other good. So let's say you're a distributor, there are exemptions out there that are allowed. The requirement is that you would need to get exemption certificates from the seller. So really, if you're thinking about moving into the US, if you want to just have a discussion with us about your specific facts, we're happy to go through those with you. It's important to have a nexus analysis so that you can have sort of a plan for your company. You want to review your entity structure and your cash flow structure so that you're well aware of what your potential obligations are. And then I think just to hit on one other thing that I mentioned earlier, it's really important to make sure that you're up to date on your compliance, because in the US we have what's called a statute of limitations. So if you file a tax return, generally you have a 3-year window where the state can go back and analyze whether you've collected the correct amount of sales tax. However, the statute of limitations does not apply if you haven't filed any tax returns. So you could be AT&T company and you never filed tax in Wisconsin since you started in 1923. They could go all the way back to 1923 and assess tax, interest, and penalties. So you don't want to be in a situation like that where you're really you know, on the bad end of the sales tax game. There is software that's available, and you know, it's really important to kind of get an advisor involved in software to keep everything well managed. You know, if you'd like to add to those, Jared, those are my sort of comments.
Sure. The only, as far as planning, and again, you want to run your analysis for the different states. The most important thing as we close, and I know we're short on time, but the most important thing to get as you go through this is document, document, document. Make sure that whatever if you run into an issue, you want to have chapter and verse for either the legislation or the applicable rule. A lot of the time it requires you want to engage the state or local Department of Revenue for a definition. How do they consider your product or your business? And you need to document who you spoke with, the nature of the conversation, the time, and what the determination was. The reason for that, as you document, you are preparing for an audit, and if you're prepared, fortunately, that audit usually never happens. So that's what you want to prepare for. I appreciate the EACCN for allowing us to do this today, and we're grateful for your time. Again, like Betsy mentioned, if there's a lot more that we didn't cover, if there are specific questions or anything that we can help with, please don't hesitate to reach out. Whether it's the getting into the numbers, the legal side of it, even the language side, we can help out with that.
Excellent. Betsy and Jared's contact information is there on the screen. We will be sending the slides around, so you'll have access to that. And let me stop the screen share and just offer a couple final comments. So that concludes today's webinar entitled "The U.S. Wayfair Decision: Untangling the Web of Sales Tax and what European businesses need to know." Thanks to our presenters, Betsy Gillen from Gillen Tax and Jared Johnson from Offit Kerman. We thank you very much for sharing your experience, your insight. And of course, thanks to all of you for joining us for today's discussion. Just a reminder, all comments and opinions presented by our speakers today are their own and do not necessarily represent the views of the European American Chamber of Commerce or its members. And just so I can do this, I want to make sure you didn't get to see them. Here's Jared, so that you can see what he looks like. I mean, we were sharing screens the whole time, guys, so nobody got to see you. And here's Betsy sitting out in her garden and having a lovely day, and we hear the birds chirping. I'm actually on the beach at Hilton Head, South Carolina. But that's what the international world is all about these days, doing these things remotely. Please stay in touch with your local chapter of the European American Chamber of Commerce for information on upcoming events and webinars. And also be sure to look for a recording of this and other EACC webinars and events on our YouTube channel. Farewell.